All right, let's dive right into this explainer and unpack AstraZeneca's latest financial results to see exactly where this global pharmaceutical giant is heading. You know, if you follow the biotech and pharma space, you already know that balancing your current commercial execution with your future pipeline development is essentially like walking a tightrope. Today, we're going to look at exactly how AstraZeneca is managing that balance. We'll be pulling directly from their Q1 2026 earnings data and their full year 2025 results to get a really clear, unobstructed view of their whole strategy. $80 billion. I mean, no, that is not a typo, and it certainly isn't some historical milestone they've already hit. That massive number is CEO Pascal Soriot's incredibly ambitious total revenue goal for the year 2030. Just to put that into perspective for a second, they just wrapped up 2025 at around $58.7 billion. So the big question is, how on earth do they plan to bridge that massive gap in just a few short years? To understand how they're planning to hit that target, we're going to break things down into 6 quick parts. First, the $80 billion ambition. Second, decoding their top-line revenue. Third, oncology and rare diseases. Fourth, the pipeline catalyst fuel. Fifth, cash flow and margins. And finally, their 2026 financial outlook.
Okay, let's get into section 1, the $80 billion ambition. So AstraZeneca's leadership is practically radiating confidence right now, and honestly for good reason. They delivered a massive $15 billion in total revenue just in the first quarter of 2026 alone. And since their last earnings report, they haven't just been all talk. They've actually secured 14 major regional approvals and locked in positive readouts for 4 really high-value phase 3 programs. Basically, they are actively pushing drugs across the regulatory finish line.
Moving on to Section 2, decoding top-line revenue.
Now, you're going to see Core EPS popping up a lot as we go through this. Think of core earnings per share like your own regular, reliable monthly paycheck. It completely ignores any crazy one-off inheritances or sudden emergency expenses like, say, legal settlements or restructuring charges. This is a brilliant way to view their earnings because it lets us focus purely on the underlying repeatable profitability of the business, rather than getting distracted by the noise of one-time events.
Looking at their macro growth over the last full year, the trend line is just incredibly clear. We're looking at an 8% increase at constant exchange rates from 2024 to 2025, which pushed them to a staggering $58.7 billion in total revenue. The main takeaway here? This isn't just some temporary pandemic-era anomaly. What we're seeing is sustained, multi-year commercial expansion.
And this growth is genuinely global. If you look at the breakdown, the U.S. obviously represents the lion's share at 43% of the total pie, pulling in $25.4 billion. But take a look at the emerging markets outside of China. That segment surged with massive 22% growth, hitting $8.6 billion. China itself added another $6.6 billion to the pile. This kind of global diversification is an absolute game changer, helping them absorb regional pressures, like the U.S. Medicare Part D redesigns or generic competition popping up in specific countries.
Let's jump into Section 3, oncology and rare diseases. There is a really fascinating dynamic driving all this revenue. On one side, oncology is the heavy lifter, bringing in massive sheer volume. We're talking $25.6 billion in 2025 alone. But then on the other side, rare diseases are providing this incredibly rapid, double-digit quarterly growth. Together, these twin engines are what push their total Q1 revenue past that $15.3 billion mark.
Let's zoom in on that oncology engine for a second. Demand remains incredibly robust, even with all the global geopolitical pressures out there right now. And it's anchored by true blockbuster treatments. Tagrisso is showing strong double-digit growth. Calquence is up 20%. And Imfinzi, that one surged an incredible 39%. I mean, these aren't just incremental wins. They're massive leaps in market penetration.
Which brings us to Section 4, the pipeline catalyst fuel.
Because, look, to keep growing toward $80 billion, you need future fuel. This is pulled straight from their Q1 clinical trials appendix, and you can see they are right in the middle of this incredibly catalyst-rich period. They've got a massive lineup of phase 3 trials. It's not just about having a few drugs in development anymore, it's about having multiple shots on goal across really high-value therapeutic areas. You can clearly track this momentum across the year. Notice how the back half of 2026 is absolutely packed with highly anticipated oncology trial readouts. You see Avanzar, Tropion-Lung 115, and Pacific-9. All of those are targeting non-small cell lung cancer, which is the most common type of lung cancer. Positive data from these late-stage trials is exactly what investors and patients are watching so closely, because it represents the next generation of potential blockbuster revenues. All right, Section 5, cash flow and margins. So innovation on this scale costs money. Where is the cash actually going? Well, on the business development side, they just closed a huge deal with CSPC in Q2, paying $1.2 billion upfront for global rights to a weight management portfolio. Meanwhile, their capital expenditures are jumping by a third in 2026 to $3.3 billion. Between a brand new ADC facility in Singapore and expanded manufacturing over in the US, they are aggressively spending to build out their future capacity. But here's the crazy part. Even with those massive multi-year capital expenditures and billion-dollar upfront licensing deals, their operational efficiency is really shining through. They've managed to maintain a remarkably stable core gross margin, hovering right around 81.8% for 2025. Basically, they are spending heavily on the future, but their current commercial engine is so profitable that it easily absorbs the cost.
Finally, Section 6, 2026 Financial Outlook.
AstraZeneca definitely isn't backing down from their goals. Their officially reconfirmed 2026 guidance forecasts a solid mid to high single-digit revenue increase and a very healthy low double-digit boost to their core EPS, and that's all at constant exchange rates. Plus, they anticipate their core tax rate to sit pretty steadily between 18 and 22%. The message they're sending here is all about stability and predictable, strong upward growth.
But to pull this off, it takes flawless execution. As their CFO noted, following their recent R&D successes, which includes high-value programs like dazorikimab for COPD, they are actively balancing operating leverage with highly disciplined commercial investments. They're purposefully increasing their SG&A, so that's selling, general, and administrative expenses, to maximize the revenue potential of these upcoming launches. You know the old saying, you have to spend money to make money? Well, you definitely have to spend money to effectively market and distribute breakthrough therapies. Which leaves us with the $80 billion question as we wrap up this explainer. We've seen the $15.3 billion Q1, the super resilient margins, and the packed 2026 trial schedule. But can these upcoming clinical readouts actually deliver the fuel needed to overcome those inevitable patent cliffs and reach that monumental $80 billion summit by 2030? Well, the second half of 2026 is going to be incredibly telling. Thanks for hanging out with me to unpack these numbers, and we'll catch you next time.